Good early Sunday morning to my Patreons and YouTubers. All right. So we had a heck of a week. We had a pretty strong sell-off, and I would say it's obviously war related. There's a few other small factors in there. I've been indicating that I thought we had further to go, but after Wednesday and Thursday, I thought that we had reached a near-term low. Somebody actually asked me, shout out to Charles, about, I think it was on Tuesday or Wednesday, if I thought it was worthwhile shorting and did I see much more downside. And my comment to that was just take something like silver. I could have said it in gold. Actually, I'll give you both. I said, so silver gets down to $62. I said, we had a first instance uh, right after the top of 120, 119 intraday. Day or two later, we're down at 64. And then we bounced, went back up, I think around 92 on silver, and then proceeded to sell with a lower low, of course, intraday. They don't typically stay at those low prices, and we touched 61. So my feeling was we're getting close in terms of price. So we were at 64, 63, we hit 62. I thought there was still a chance to see 61, 60, perhaps as low as 58, 57. Wasn't counting on that. And when you look at it that way, you say we're 95, 98% of the way down. So shorting or buying a leverage 2x, right? Something like J Dust. Um, that's a inverse of the bullish J Nug. Um, and I think there's a dust for Nugget, but look those up. And then you have your GDXU triple positive and whatever its inverse, GDXS. I can't recall. I like that one a little less because the leverage doesn't quite hold as strong. But in other words, I felt like sentiment had us fairly low. So again, sentiment and gold and metal, if you constructed those numbers to gold, we were at high 43s. I said we should see 41. We had seen 40.90 in one of the previous retraces. I said 4,000's in the cards, clearly, and could go to 39. We could go to 38. I didn't think 35 was a reachable and don't really still think that's a target number we'll touch, but we could. So, having said all that, I wanted to show you some macro fundamentals. I wanted to talk about how oversold I think we are. And sure enough, on Friday, it's always attacked. Somebody will go, yeah, but that's because Trump said we're going to sign a peace deal. Well, good luck with any peace deal lasting with Iran. I just don't think their psyche, their irrational, their religious deep beliefs will allow them to do anything that we would accept as a deal. So we may sign one, but a week, 2 weeks, 3 weeks later, it may blow up. It could blow up in a day or two. So I don't feel like we're going to be bailed out by the war, nor do I believe that the war is the full rationale for us selling off. Most conflicts and wars, we end up going up. They can take time, though. They may take 3, 4, 5 months. Well, we've really only been in this last situation, 65 days? So I think the impact negatively on the economics and the higher short-term interest rates can actually end up being positive. I'll remind those people that say, well, you can't have high inflation and high interest rates and have gold go up. It doesn't like that environment. Well, go look at a chart of the 1970 commodity supercycle, which we map to the closest right now. And in 74 to 76, you had roughly that 50% retrace. We've only had about a 30% retrace in gold. Well, do the math. I think 56 to 41 probably is close to 28, 29, 30%. But I don't know that this is the time we get 50%. And it oftentimes isn't measured exactly like that. It's measured where you started from, how high you went, and then did you pull back. But essentially, in that 70 commodity super cycle, it touched close to 200. I think 193, 198, 200, and then proceeded to go down to like 101. So it might have been 46%, but it was pretty ugly, right? And then what did you have in 76 to 80? You went from 101 to $850. You 8x in 4.5 years with 5, 6, 7, 8 double digit inflation numbers, right? And gold went up 8x. So don't rule out gold. Don't rule out silver. Now, there's another factor that can help, and that's real inflation rates. The difference between what inflation is signaling and what short and long term rates actually are. So there's all these different things. So gold can go up in inflationary times. It certainly is a hedge in deflationary times. So think of gold more as money than paper money. Paper money really isn't money. We call it money. So somebody that invests in gold, I would argue that in itself is incorrect. You don't invest in gold. You invest in money. Gold always has been, historically, been money. Fiat currency is just that, something that declines in value. We try and sell that as inflation. But if you want to hold steady with inflation, you need real money, not fiat money. So I am still just as bullish as ever on gold and silver, recognizing that one can go broke if all you do is buy at the tops, right? But if you average down and average in, somebody said that was leaving my Patreon. Oh, I think everybody's just rich in there. You talk about buying when it goes down. What if you only had a little bit of money and you bought near the tops? Well, I do indicate when I think people should trim. And I always talk about trimming, but I can't manage each and every person's portfolio. And then in January, I was saying to people, early January, we seen toppy in the metals here. Here's an area that I think is just starting that you should be getting into. And I called it energy. Within 45 days, we had 50, 60, 75% gainers on many of those things. Because when you're in a commodity super cycle, money rotates around. I've shown some of you the commodity, AI commodity super cycle, right? So the AI super cycle is actually increasing and driving commodities, not necessarily gold because it's not industrially used. Copper, silver, the base metals, rare earths, uranium, you better believe that the AI supercycle is driving that. The real question is that capital spending going to stay at 800 billion going to a trillion over the next couple of years? If that is successful and the credit issues and banking credit issues don't hit the market and knock it down, then we can move through those phases at times and buy AI, super cycle infrastructure plays. You just have to be careful when you look at something like DRAM and you look at SanDisk and you say, hey, it's up 4,800% in the last year. Well, is that closer to a top than a bottom? You bet it is. Now, as long as that shortage of supply exists, there will be a floor in that price. But I sure don't want to buy it today, even if it's going to go up 35% in a month, because I don't know when it rolls over. And when it does roll over eventually, it's probably going to retrace 60% of its height. So when you start buying it at that 4,800% gain, and now it's only up 2,400%, basically you lost 50%, just like we've seen in some of our miners. So be careful where you buy. That's even in semiconductors. That demand hasn't gone away. But I'd rather be buying in the semis that have to do with optics and photo electronics, right? Where we need huge bandwidth and speed, and we need to cut the power out of something like copper supplying that. So for those extreme AI bandwidths, we want the optoelectronics, and I've got a list of 39 stocks there that are doing fabulous and will do fabulous. Then another part of our AI super cycle is space. Now, I have a feeling that we may sell off or we may run for a week or two here and then sell off. It's a lot of times it's, buy the rumor, sell the news. Well, the news, it's now launched. But over time, do I see those plays in space and drones and defense and a lot of that still going strong? You bet. Um, but I think the markets will be subject to a rollover at some point. And that will be very positive for the precious metals and the miners. May knock them down for the first couple of days. But you have to remember, even at 3,000 gold, most all of the miners today, and at $35, $40 silver, they're all making a lot of money. Now, there's some mines that came back into production that needed $40 silver. Well, they didn't have it until recently. So you restart a mine like that at 65 silver, knowing that you're likely to go to a buck and a half, 200, 300, 400, 500. I'll show you some charts on that. So there's a lot of upside here, guys. And I'll try and establish why. Because people, if you just tell people something's going to happen, they logically want to know why. Why do you think that? So that's the point. So when you look at this gold miners bullish percent index, in history, here's 10%. Look at 0%. We haven't been to 0% in the last 10 years. But we just hit it on June, 10th. And then what happened on the 11th? Got a nice bounce. Oh yeah, because they signed we're getting a peace deal. Guys, I always say, look at what the trends are, understand technical analysis, and probably even more important, the fundamental analysis. That's what I'm talking to you about on the fundamental analysis. Some of this has to do with technicals, but the fundamental reason is why. And wait till we get into silver, I'll talk about that. So while it looked bearish with war, in the chart below, you see the historical returns 3 and 6 months out when bullish sentiment hit zero. I'm going to show you that chart in just a minute. I did it separately in GDX, in TradingView, and I didn't simply copy it. So I'll drag that over and I'll move around and I'll show you that. But all the other charts are in here. So when you get RSI dropping down at these low points, and so we're going to take a GDX chart in a minute that I have in TradingView and show you these retraces. And then show you what happened 30 days later and what happened 60 days later and what happened, 30 days, 90 days, and 180. If you've ever seen any of my charts, you know I like that. 1 month, 3 months, 6 months. I don't show 12, but we could. So typically, you do very well after a while when you reach, these extreme oversold. Anything below 10, right? We had a 7%, an 8%, a 7%, a 4%, and a 0%. How about that? All right, so let me go get that chart for you guys. Excuse me. All right, bear with me here because I kept this on the weekly level and it moves my little chart. So we're going to go back and we're going to look starting with November the 14th, 2016. All right. So BPGDM, the bullish percent, right, on GDM was only 7%, right? When it gets below 10%, that's pretty extreme. So what happened a month later? Well, you can see I pointed, remember this is weekly. So I pointed to the week of November 14th, 2016 on the chart. So the next week it went down and then it went up, okay, and then was technically down 9.66 1 month forward. And then 18 and 7, you can kind of see it was kind of trending flat. It came back and retested here, but that was, 11 months out. That was November of 18, not, well, actually 24 months. So, um, when you get extreme, you usually get good, strong bounces over time. Like we didn't have an extreme oversold here, but had we had one, look at this. Look at a few months, further out. So probably ought to build one of these that's GDX 12 months forward. So you can see here, this red candle immediately, one more week, 2 more weeks, 3 more, 4 more weeks, right? No wonder you had a nice bounce. You had 6% in a month. You had 21%. You had 55% in 6 months, right? So for March, where would that be? September? Yeah, here's your September. Not the exact highs, but certainly higher than down here. That's why you had 55%. So the point is, it's just logical, right? When RSIs get extended like that, you're going to bounce. And look at us. We came down, went up, came down, very likely an A wave down there. And it looks like we've had our B bounce. And it looks like we're in the finishing of C capitulation. Now, and we went lower. That's what I look for these intermediate, these 4 or 5 month correction. We didn't get that in October, right? This was our October sell off. And I was worried about this one. Or sorry, here, guys. This was the October sell off. We were extended and, we flew up, sold off, had this A wave down, A, B, C for an A, moved up in a B, barely, our C was muted. And so it ended up being a triangle, and it was what I call a halfway. What is a halfway? It means from the bottom going up, right? You could take this bottom likely, right? Because we retraced and look, and this was pretty close to the halfway point. And when you have a ABC equal wave or having the C wave lower. So instead, we finally got a more substantial. This just about times with the 5 month retrace segment that's been consistent going almost all the way back to the 70 commodity super cycle. So for over the last 25 years, we haven't had a longer than any particular correction, longer than 5 months. Well, at the end of June, our 5 months is up, right? Because we started to sell off 27th of January. So technically, that would be June 27th to be 5 months. No, could we go into July and August? You bet, right? There are exceptions. But I don't see a plummet. This is looking at GDX, guys. So, but you get the idea. If this was silver, you'd see almost the exact same thing. If it was gold, you'd see very similar. Silver sold off a higher percentage. But you get the point. But this is what I wanted to show you is how this holds true. So you have to buy when things go on sale. You have to be patient. But that's why I had people come into my Patreon in December and they came in January. Why? Because they were seeing what I said from June, July, and August when I had all my recommendations out there. I didn't start Patreon until August 8th, but on my YouTube channel, I was recommending gold and silver miners in May and June. And they just rocketed, right? August really got everything lifted. So it's pretty hard to tell somebody new that wants to get in, don't buy anything. What I do is I say, go in, buy a third. Do not buy all in here at the end of December or early January. We're too close to a top. Save some dry powder. Always say that. And the people that got in July and August, you need to trim. You get 100, 150, 200%, you need to take a third, or you need to take some percentage off the table, because inevitably you're going to get a retrace. You have an 8 months going forward, you have 5 months of retrace, hopefully we have another 8 months. But your impulse waves, your up moves should be greater, not always last longer, but should be a much higher percentage than the down wave. And then you had multiple opportunities here when you get into this kind of a play. Let me bring this back over. Look at this. To trade these a little bit, I don't take my core position, get right, set, tight. My 10 baggers, my 25, my additional list of 15, I don't trade those. Okay. So I take a hit on those, but I trade things like Nugget and AGQ and JNUG, right? ZSL for an inverse of AGQ. You have to, when you go into this kind of setup, just like you want to be buying down here, you wanted to be buying down here. And then when you start, you ride it and then you close it out. Now that we've had very likely the final, now we could bounce a little more. To me, we have to close above 80, right? This is GDX, guys. But if this was a silver chart, we're at 76. We need to close over 80 to signal that we're not very likely to come back down to 61 or 60. Otherwise, it's still open, right? So again, I'm looking at a candle on GDX, but I'm talking about silver. All right, guys. So let's finish this. There's a little bit more. So on the Kobayashi letter, basically it tells you, but you can just look here at the chart. China central bank gold purchases in tons, right? So most of this data, here's 10 tons, here's 9 tons, 8 tons, 5 tons, smaller. Look at this consistently, month after month after month. These are monthly bars. We don't have June's data yet. We have May's data because June isn't over. But my sense is they probably bought a higher amount in June. Why is this going up? Because the price has been coming down. Guess who's a pretty good trader? And they're not trading it. They're not selling any of their gold. They're not selling any of their silver because they know it's money. And they know fiat isn't, including their own yuan, renminbi, whatever you want to call it, right? So, guys, let me take it a little further. I'm going to get you back into silver price in a minute. Some of you have seen this. I showed this previously, but it's relevant to a new chart that I'm going to show right after. So what I wanted to capture here, and I went through all these formulas in detail to do it, it was not easy. And then I decided to create a different chart for silver to show you how to look at silver in a different way. So the idea was, we know what M2, right? Most of the U.S. is money. You can look at M2 of any country. This was done on the U.S. dollar, on U.S. M2. So it's money in the banks. It's liquid things that you can sell quickly to get money. In other words, it's cashable assets, right? And you measure that. And if I just showed you this chart, the line would go from down here to up here as the U.S. M2 money supply grows, right? People can take a loan, they can borrow. And that money is still cash in the bank, even though they have a debt again. and only measured as cash. Okay. So the M2 is what's the growth of money? So if we run a big deficit, we have to print a lot more money, our M2 is going to grow. So these lines, so copper is orange, yellow is gold. This is base metals. It didn't go back far enough that I started only wanting to use lead. And then obviously silver and gold go back the furthest. So what's the idea here? Well, the idea is that silver has been held down unlike any other really physical asset, commodity, and especially any precious metal or base metal. Nothing else has been held down and manipulated like silver has. So now silver's got a real wind at its back in a sailing scenario. Why? Because we've had a structural deficit for going on 6 years. Silver is an electrification. It's used in so many things. Guys, I always forget them when I need to say this. I should put a little card. But 5G, imaging and medical, solar panels, phone, mobile phone, so many satellites, communication in space. There are so many uses for physical silver. And yet it has that dual personality. It's schizophrenic. Half of it is a precious metal. It's poor man's gold. Who can afford 5,600 for an ounce or 4,300 for an ounce? Not many people to buy a lot. So what do they look for? They look for silver. Used to be $4, $8, $10, $12. I mean, my last monster buys were in 14, 20, $24 silver. So having, 4 monster boxes when you got a low price in silver and you see $120, you go, yeah, it's nothing compared to the ounces of gold. But just say it, right? So how are they able to keep silver down and why? Well, it shows up on this chart. Look at the negative percent of the growth of the metal versus M2 supply. Every one of these metals has the same M2 ratio. So copper was an asset that was always in the 50-cent range for quite a while. Then it got as high as $1.50. So it was 50 to $1.50 for a long period of time, a decade or more. Then it structurally broke out, got up to 250, 350, and all of a sudden you had a new high level. Then it pulled back. The old floor was the previous ceiling. Now we're looking at $6.50 silver. Okay, so it's done pretty well. Or sorry, guys, when I said silver, I meant copper. So look at gold. And you can see here that what is this? The 1980 peak, right? The commodity super cycle, 1980, $850. 8x from down here. Now, this is measuring M2 ratio. I'm just telling you in price. Well, actually, these years are bigger. So that would be somewhere over here. This would be like 76. So 76 to 80, that kind of move was 8x in gold. And then you peaked again, bottomed around 2000. Gold was $250. Late 99, early 2000, right here. And proceeded to run for the next 11 years and peaked at 2011. A less of a peak, right? Didn't get as high as it did before to the money supply. And then continued down. 2022, we sort of bottomed. And ever since then, we've been on a rip until just recent. And look at your base metals. This is tin, lead, zinc, several things here in the base metal. And look at silver. Silver is just pitiful. Look at the 22 low here in silver. Because part of it is precious metal and part of it's base metal. But guys, for 50 years, silver never broke $50. 1980, 2011, all the way up to November of 2025, silver couldn't get out of its own way and break $50. All right. So here's the next chart I wanted to show you. Whoops. Where the heck happened to my... I pasted the wrong one. All right, guys. Oh, that's bothersome. All right, let me go find it. Darn. I'll open it up on the other side and then I'll bring that over. Darn. I pasted it and I pasted the same one. All right. Sorry, guys. I opened it. Now I got to find it. I have 15 tabs open on the other screen. Ah, sorry about that. All right. So this is what I wanted to show you. Oh, all right. We'll just do it this way. So silver as a percent of gold. I had been doing, like a lot of people do, the GSR, gold silver ratio. And you learn, 48, 50, 63, blah, blah, blah. And I could show the same chart with the previous stat. But I got bored of that. Honestly, it's harder for people to imagine. So I just inversed it. I said, okay, in 1980, I know that gold was 850 and silver was 49 something. Bottom line, it was 6.8% if I look at it. And this chart is in percent. So I did some divides, I did some work. We'll get to these yellow and blue. They're important, but let's just look at the chart. This is your 200 weekly moving average because this is on a 1 week. Okay, silver divided by gold times 100. So our next commodity super cycle in 2011, I think this was April. I think gold, I mix them up. Gold, I believe, hit its high in August and silver hit its high in April. I could be wrong and they're inverse, but bottom line, gold went to like 1920s, 1923, something like. And so that was only, guess what? Less than half of what it went here. So while it looked big in some ways, it's really not, right? 3.28. Sorry, guys, I said gold. This is a silver chart. So back to this. $49 on silver, high 49s, high 49s on silver again. Gold was 1923, silver was high 49s. So same percentage, just different, right? Because you have to know the gold price to get the percentage. So we had 1923 and we had 49. We had 49 and we had 850. So you can see that that's a little bit more than a double. So this is going to be a little less than half of that. Well, I don't think we stay on this line that much longer. I think because of the structural deficit and some other things, we only hit 2.2% of gold. Go back and look at the roughly 55.98 and then divide our 120 something, 119, 120, and you get 2.2 something. So one could argue, if you just believe nothing changes, that the next time silver gets up, it'll bump against this line at a lower percent. I don't necessarily subscribe to that, okay, by a lot of the other information I was telling you. So when a Michael Oliver or somebody, a Rick Rule or somebody starts talking that's known in the industry and somewhat trusted, talks about extremely high silver numbers, is that all BS? Sounds like BS if you can't justify it. Well, let's take a look at it. Okay. So let's say that we break out of here. Well, when you break out of a 57-year trend line, if and when you do, you will rise substantially. That is technicals, right? Something like this, you come up, you come back and test a breakout line, and then you usually rip higher. Well, what if you only go a measly little 3.28 over here? What's that look like? Well, part of it depends on gold, doesn't it? We know what the percentage would be. So if silver goes back to 3.28, let's just assume it can get there. Then we have $262 silver and 8,000 gold. Well, what if I said to you that I think gold is going to could be 26? Look at, if we don't get going, in other words, if we don't get going in late June, early July, early August, it's going to be a little bit harder. But even getting going in early August, I think by September, October, November, we could see anywhere from 66 to 8,000. 8,000 would be the extreme in 2026. So I wouldn't bet on that. But I'd bet on 6,000. I'd bet on it with options when I buy silver futures. So 262 is mundane, but what does that look like from where we are now? Take 262 and subtract 67. Guys, that's $195 higher. All right, so it only goes to 7,000 gold. Do the math, right? All right, so later years, I think by 2029, we could see 10,000 gold. That's 328. I think 15, I've long said that 15 was a target for gold. $492. Well, when you hear people say, my target has been 350, but that was just a number I plucked out thinking that we should go that high. But I can see that that's only about 11,000 in gold if we get to the percent, which I don't see how we don't. They didn't have a structural deficit here. They didn't have a structural deficit here. You just had somebody trying to corner the market. And the futures market just shut them down. They showed the Hunt brothers, changed the rule. No more buying of silver, only selling. And that's what happens when governments go bad, or governments don't want you to hoard something. But the problem in silver, a lot of people want to hoard it, and no single person can hoard it all, mainly because they can't get enough of it and it's needed in industry. So, guys, this is the conservative side. What if silver goes back to 6.8? You say, well, it can't do that. Really? You're telling me if this breaks out and gets to $3, I would say the odds are 75% that it goes to 6 or above after 3. So you see how the movement has to then forecast the future movement. Yeah, it has to break out again. But it will. So at 8,000 gold, late 2026, mid 2027, 544 gold may or may not happen that soon. We might only be in this range. $680 at 10,000 gold if we got to this level. 1020 at 15,000 gold. So when people say $1,000 silver can happen, oh yes, it can. Now, it's just like a lot of things. 15,000 gold sounds high, but it's not. When you get to 5,600, let's say we get back to 5,000, we're at 43 something. We get back to 5. It's a double to 10. You just saw gold go from 2,200 to 5,600, right, in a very short period of time, a couple of years. I can remember it being 1,800 not that long ago, a little over 2 years ago. We're at 56. These things become nominal. From 6,000 to go to 7,000, it's 12% increase. From 7,000 to 10,000, 40% increase. All of a sudden, it's not reachable. Look at the stocks. Look at these AI infrastructure. You just had $4,800 increase in 12 months in SanDisk. Why? Because you got tons of spending on AI infrastructure and there's a shortage. They can't make enough. So what do when you have everybody clamoring and a very small supply? You jack the price up. We saw it with GPUs. We saw it with used cars in 2022. Why? Because of the COVID and the chips. They couldn't get any of the chips. All the new cars are computer chip oriented. So the used car inventory shot way up. But how would you like to be buying when it was turning down and then trying to unload that? So guys, there's a lot there. Don't think something can't change. Just like we could run to this ratio and turn around and come back down to 2.8 and then go higher after that. So you have to look at what drives it. I said oil would go higher at $60 oil. We were 55 at one point. I said I see $100 and $200 oil. I didn't want to tell you I saw 4 and 5 because you would have thought I was nuts. And then we started up. Well, yeah, but that's because of the Iran war. It's always, yeah, but that's because of. Well, it's easy to see the structural deficit. The big oil companies aren't drilling. It's more costly to find oil, right? What do you think is going on with the metals? There are no pure play silver miners. None. They have 40, 50% silver value of their production. There are no pure silver mines. They all got some gold. They all got base metals. And guess what? We're declining in our production. We're getting the same way in gold, but gold is not needed. Gold is money. That's what's driving gold. That's why the central banks are buying. They see it as money because they don't trust paper money. But silver is going to go up. Some reasons for that, and a big reason for its industrial demand. And when you've got to make solar panels and the metal goes up double or triple, it's still a small percent of the overall silver, the solar panel. It's the paste. It's all the connectors. You want a more efficient, you want a more powerful solar panel, you need silver. You use something cheap, and that's what you're going to get. You're going to get something that wears out in a year or two and doesn't conduct electricity very well, doesn't get the power back to the grid or to the homeowner. So sometimes there aren't alternatives. I say that about spot price of uranium. Everybody argues, well, it was $30 and now it's 80. It can't go to 250. Do you know what the cost if you're running a nuclear reactor of the fuel is? It's less than 1%, maybe 2%, even if it doubles or triples of the operating budget. It's nothing. What are you going to do? Not run your nuclear reactor that's producing a gigawatt and you're selling a shitload of electricity because uranium tripled yellow cake? No, you're not. So sometimes that's what you have to do. Look at the suppliers now for DRAM. They don't like it. You hold your nose and you buy if you have to have it. Me, luckily, I bought a 96 gigabyte computer in October and I was in the States. I didn't even know that it was real and happening as much until I said, oh, I think there's a new model out that's faster. Let me look and see what it is. And I thought, the new model is going to be about what I paid in October. I'll wait another 8 months and I'll buy the new, more powerful model. I looked and I saw what I bought was up 60% from what I paid for it in October. Well, that doesn't happen in electronics. And then I got to understanding why. So thank goodness I bought 96 gigabytes on my computer. And then AI processing and a lot of other things that I knew I needed. So guys, very interesting. Hang in there. I know a lot of you guys, no one likes when it sells off hard. But you have to buy. You have to find a way to save cash. I was up to 35%. I'm only like 15% now. I've been gobbling up stuff like crazy. I had a couple of $68 orders for AGQ. I don't know that they'll get filled, but I'm leaving them out there. Probably correlates to, 57, 58 on silver. All right, guys, have a good one. Wanted to get this out. I got some more. I got a whole different video for you. Um, but hang in there. Don't, when you get something right and it retraces, all markets retrace. I'll tell you one that's interesting. I'm kind of bullish right now on ARM. But look at the ARM chart. 7, 8 months ago, it was thrown out with a baby with a bathwater. Nobody wanted it. But I think AI is going to drive a lot of demand for ARM. So I think it's got a lot more to go than just semiconductors or, right? It is a semi, but the nature of how it performs is more AI, sympathetic. So Apple uses it almost exclusively. I see a lot of future for ARM. And then ultimately, right, different compute methods, the quantum stuff. But we got to grow into that. We're early, but that will have its run. But now, what do you see? You see them rip up 200 or 300% and get cut in half. So if you don't time it right, you're screwed. My problem is that whole thing can get defeated by a recession. If we turn down and this credit crisis really hits again, that could take the markets down. And again, if it hits the metals initially, they go down, and then the gold and silver stocks go down more than the metals go down. But then they look at it and say, wait a minute. That's dependent on precious metals and rare earths and base metals. We need all that stuff. Even in a recession, we need all that stuff. We can't get to space. We can't get to all these other things. We can't put satellites. We can't communicate on our phones. That's like sometimes the argument for a Procter and Gamble or somebody that makes baby diapers or whatever. It doesn't matter if you're in COVID. Heck, in COVID, you had more pregnancy, right? So there are just some core things that are good to own. And then a lot of the subjective tech that you don't have to have, that stuff doesn't go up. All right, guys, that's my rant. I've kept you way too long. So I will try and get another video out on Sunday. This one you'll see bright and early. All right, guys, bye for now.